The Banking Royal Commission will hit the Sydney and Melbourne property markets hard as lenders tighten up their policies. Property data analytics company CoreLogic said bank credit policies are unlikely to be relaxed, making it more difficult for borrowers to obtain loans. Australia's two largest cities both posted 0.4% declines in housing prices in April, with further falls expected throughout the year. Credit rating agency Fitch Ratings has warned a severe housing market downturn could in turn lead to a downgrade in the ratings of Australia's Big Four banks. Credit policies aren't likely to be relaxed, CoreLogic head of research Tim Lawless told News. Borrowers who could have borrowed money for housing finance 6 months ago will find it more challenging, especially if they want interest-only loans or are buying for investment purposes. Combined with stricter lending policies from the Australian Prudential Regulation Authority, the bank's reactions to the Commission is likely to see prices fall further. The effects are likely to be most severe in Sydney and Melbourne, which show the biggest monthly falls in April. Fitch Ratings carried out a stress test on Australia bank ratings released on Monday and stopped short of predicting drastic housing market declines. The stress test was undertaken as risks within the household sector have continued to grow, and Australian banks, including the four majors, have large exposures to residential mortgages, Fitch Ratings said. Our central scenario is not a sharp or substantial correction in Australia's housing market, and we believe the outlook for economic growth and unemployment is relatively benign. Fitch Ratings predicted house price growth would moderate throughout the year as banks tighten up and housing supply increases. The Monday report said a major downturn in the property market was only likely to be triggered by fast rising unemployment or drastic rate rises. A rapid rise in the unemployment rate remains the most likely driver of a significant housing market correction, although sharply higher interest rates would also pressure some borrowers given the high household debt, the report said. Australia's household debt-to-income ratio is sitting at a record high of 190% due to investors taking advantage of low interest rates to buy into the housing market. Combined capital city dwelling values were 0.3% lower over April, with the falls in Sydney and Melbourne followed by a 0.1% drop in Brisbane.Perth saw flat conditions, while Adelaide enjoyed 0.1% growth, and Darwin and Canberra prices rose 0.6%. Hobart, which has seen 3.6% growth over the last quarter, was the only capital which saw April increases of over 1%.